听见资本本期视频为您带来的是摩根士丹利在3月13日闭门会关于锂电池与电动汽车行业的关键内容。全球汽车市场正经历一场巨变，而锂作为电动汽车电池的核心材料，其市场动态牵动着无数人的目光。疫情后，全球汽车产量至今未能恢复到疫情前的水平，这在所有周期性行业中独树一帜，价格飙升，让消费者望而却步，可负担性跌至历史低点。许多人推迟买车，或者转而选择更便宜的车型，这直接导致了全球产能过剩的难题。在欧洲，汽车价格上涨尤为明显，普通家庭需要工作更多周才能买得起一辆车，这也让电动汽车的普及之路更加坎坷。说到电动汽车，中国市场遥遥领先，渗透率远超其他地区，价格优势和政策支持功不可没。相比之下，欧洲和美国却因高昂的溢价和政策的不确定性而步履维艰。欧洲近期调整了二氧化碳排放法规，给了车企3年缓冲期，这稍微缓解了压力，但电动汽车销量增长依然放缓。与此同时，中国电动汽车正强势进入欧洲市场，尽管面临关税限制，价格优势依然让他们难以被阻挡。欧洲车企甚至开始寻求与中国品牌合作，以保住市场份额。电池行业也在调整步伐。关于韩国电池市场的现状，政策的不确定性让厂商情绪谨慎，纷纷削减产能并转向成本更低的磷酸铁锂电池。行业整合的迹象出现，一些公司甚至申请破产。而在中国，强劲的储能需求推动了锂市场的活跃，但供应端反应迅速，大型电池厂商重启矿山，以抑制锂价上涨。短期内供过于求的局面难以扭转。拉丁美洲的锂资源潜力巨大，尤其是智利、阿根廷和玻利维亚的锂三角，尽管资源丰富，政治因素却限制了开发速度。智利与 SQM 达成增产协议，但幅度有限，而阿根廷则因亲商政策迎来增长机遇。整体来看，政治的不确定性让这一地区在全球市场中的份额提升受限。库存和产能问题同样值得关注。电池供应链库存已大幅精简，若需求意外回暖，可能引发增量订单。而中国国内产能仍有扩张空间，尤其是成本低廉的盐湖提锂，但非洲将成为未来增量的主要来源。总的来说，锂市场和电动汽车行业正处于机遇与挑战并存的十字路口。政策调整、技术进步和市场需求的博弈将继续塑造这一行业的未来。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello, good morning, good afternoon, and welcome. I'm Rahul Anand from the Australia Materials team, and I've got with me today a bit of a panel on lithium. So we've got Javier and Young Suk, who both cover lithium and the downstream markets. I've also got with me today Rachel Zhang, who's obviously the head of our China materials team, and she also covers lithium stocks. And then I've got myself, of course, covering lithium out of Australia. The focus of today's call is obviously on the lithium market broadly, both the upstream and the downstream. Just a few quick notes on the format of the webcast and the call today. Just as a note, this webcast is being recorded and is strictly for invited corporates, Morgan Stanley institutional clients, and wealth advisors only. If anyone from the media is dialed in, I do request you to please disconnect here and to reach out to me separately. We'll start today with some brief comments from all of our speakers, including myself, just on the latest mood in the market and how we're seeing investor interest, but more importantly, the latest in terms of both the consumers and suppliers of lithium. During this time, you can start sending your questions through. The way to do that is through the Q&A dialog box in the webcast service. And once we step into the Q&A section of the call, I'll pick up those questions. Typically, we do tend to try and keep these calls to half an hour to 45 minutes, but we have allowed up to 1 hour. So we won't be stretching it. We'll keep it punchy. So if you have your questions, please send them early on to avoid for them being missed. So look, with all that out of the way, welcome everyone. Javier, I think I'm going to go to you first. Thanks.
Sorry, I was on mute. Thank you, Rahul. It's a pleasure to be here with you guys, with the global team. Obviously, this is something that makes us quite different, the capacity to collaborate, and we do it. We have been doing this for years. We have been working together for many years. So I used to cover, and I still continue to cover lithium names in Latin America. In a couple of years ago, I moved to Europe also to cover autos, European autos. So I'm going to share with you maybe that perspective. That is where it is the angle that is today quite interesting because of all the regulatory changes that are happening in Europe. No, to start with, I would like to show you. I would like to build this step by step. No, starting with global auto volumes, and there out of that, how the market share is evolving in terms of who is building those cars, if those cars being internal combustion, those cars being electric vehicles. No, so let me start with the global auto volumes, and I'm going to share with you a couple of charts that are quite interesting. So the chart on the left is the global auto volumes. We build this chart bottom up, so we go to each auto association globally. In fact, this is not 100% of the countries. This is like the top 20 countries. So in reality, the global auto production is a little bit above that. But with this, you see a good picture of what is happening, quite updated of what is happening in the global auto volumes. No, it's a pretty long series. What you have is like in any other cyclical sector. What you have is that volumes were growing. Obviously, there is a seasonality. Obviously, there was an impact in the financial crisis. You see that in 2009, and then volumes continue to grow. And that if you overlap here, I don't know, any other cyclical hotels, airlines, restaurants is quite similar. We had COVID. COVID was obviously a disaster. Volumes collapsed, and then there was a recovery post-COVID. The difference, what makes auto different to other sectors, other cyclical sectors, is that auto is the only sector globally that has not recovered pre-COVID levels. This is quite interesting. It's the only sector globally where volumes are still below pre-COVID level. This is obviously for the auto sector globally. This is a big problem. I think about the auto sector is a fixed cost business, like similar to lithium, where you have an installed capacity. So the demand was growing, the installed capacity was growing in parallel to the global demand. Eventually, the global demand fall, and the global installed capacity did not change. So we have not reduced the installed capacity. So we have what we have is a big problem globally of overcapacity, low level of capacity utilization, and this is what is happening. The reason for this is affordability. Affordability means how much you can pay to buy a car. The affordability has been at historically low levels. No, the reason for that basically was prices. I'm going to show you the prices is something difficult to track globally. We track that. I track that in my companies, in the European companies. So the chart on the left is the evolution of global. So the evolution of the average selling price of European OEMs. I build this chart bottom up. So the average selling price of Mercedes, the average selling price of Volkswagen, the average selling price of Renault, etc., weighted by revenue. And what you see, this is a pretty long series, and you see that prices for autos, historically they have been growing up and down through cycles with inflation. And there was a big jump during COVID. No, that big jump is mostly driven by price, but also by mix. So average selling price is driven by mix, price and effects, but there was a big jump in prices. Anybody who bought a car in 2010, 2015, then eventually you want to replace your car. The global fleet is getting old, European fleet, but also global fleet. People want to buy a new car. People go to buy a new car in 2022, 2023, 2024, and what they find is that a car that they bought, a Renault 5 that they bought at 25,000 euros, now they go to the dealer and you have to pay 40,000 euros. Oh my God, what is happening with this? No, so basically you have to pay double the price. No, and that basically kill affordability. This chart on the right is a way we use to measure affordability. There are different ways to look at that. This is particularly Europe, but we do the same for other countries. And this is number of weeks that a normal family has to work to buy a normal car. And what you see is that at the end of 2023, it moved to all-time high levels. So affordability was at all-time low levels. So what you have is that people going to buy a car and then finding that they couldn't buy it. So basically, many people postponing the acquisition of the car. Okay, you can wait. So, instead of buying the car today, let's wait and we come back next year. And this is the reason why global volumes have not recovered pre-COVID level. The second thing that is happening is that people say, okay, I cannot buy this car. Let's buy a cheaper car. So instead of buying a Renault 5, let's buy a Renault 4. This is the reason why average selling price for European companies is falling. European companies, they are not reducing prices. What is happening is that they are selling smaller cars. And the third thing that is happening is that those consumers are going for cheaper options. So they are basically buying Chinese cars. No? And this is also something I wanted to share with you. All this presentation is a presentation we did yesterday in a conference here in Europe. It's available in the web page. We released this report last night. No? So this chart shows market share. This chart is China market share, but the idea is that the same that is happening in China is happening globally. Obviously, China being a leading indicator of what may happen in other geographies. No, we will talk about that in 1 second. But this is also a pretty long series, and what you see is we have aggregated the market share of cars in China by the origin of the OEM. No? And what you have is the green line is the Chinese OEMs that if you go back 2 decades ago, they used to be 1/3 of the market. Through cycles, they have been increasing market share and they have reached 40% a few years ago. And now take a look at what happened in the last few years, moving from 40 to 60% plus. Wow. With no bumps, so it was a pretty steady market share gain, and it's the Europeans, the blue line losing market share, is the Japanese, the orange losing market share, is the light blue, the Americans losing market share, is the Koreans losing market share. The only one that was not in that trend was Tesla. So, and this is happening for good reasons, because the Chinese, they have a cost advantage, they have a product advantage, they have a speed to market advantage, but also something that we may comment later if somebody has some more interest, because they have a more aggressive commercial strategy. Basically, because there is a low level of capacity utilization globally, including China, the companies with a cost advantage, they are taking advantage of that advantage to try to gain market share. So being very aggressive from a commercial point of view, pushing prices lower, and basically that's what is happening. No? So putting all the pieces together, what you have is that global volumes have not recovered. The mix is moving from traditional OEMs into Chinese OEMs because they are very aggressive with the prices, and even with that, people are buying smaller cars in Europe, in the US, in other geographies. You know, that applies to all kind of cars, no, including internal combustion cars, including electric vehicles, etc., etc. Now, regarding the penetration of electric vehicles, this is a report also we released on Monday, that is basically because there was a regulatory change in the CO2 regulation in Europe. No? In the chart on the right, you have our expectation of penetration of BEVs, pure electric vehicles, globally is the gray area. So this is about electrification. So in the next decade or decades is about electrification. There are other technologies that are coming and other technologies that we have to consider, but we still think that we eventually the global fleet will move into electrification. Is that the question is, or the debate is about the speed of that electrification. Okay, and obviously there are countries that they are leading in front of other countries. China is the country that is leading in front of everybody else. Is the green line and is the reference, and then everybody else is lagging behind. Europe was not that far away until 2018, 2017, 18. Since then, the problem was affordability. So in Europe, the regulation and the governments are also pushing for electrification. There is an agenda of electrification. The problem is that the difference between China and Europe, the reason why China penetration was moving faster is because of price difference. So in China, you were able to buy and you can buy today an electric vehicle, the same car car, electric vehicle at the same price, if not cheaper than the internal combustion. That's not the case. That has not been the case outside from China. In Europe or in the US, you have to pay a premium. You have to pay 10, 15, even 20% premium at a time when affordability was at all-time low levels. So people were coming to the dealer to buy a car, and they were surprised with the price. So I cannot buy it, or either I postpone this and I will buy the car. I will come back to buy the car, or I buy a cheaper car, and the dealer is offering me to buy an electric vehicle, but I have to pay a premium on top of that price. No, so that has been the problem. No, everybody talks about range anxiety. Everybody talks about residual value concerns, and that's fair. That's true. That's part of the problem. But that problem is global. So that problem is similar in China to Europe or in the US. What is the reason why China has been moving faster? We think that the only reason is obviously you have sometimes incentives, but also the main reason is that the price gap has closed in China, and the price gap did not close in other geographies. It's starting to happen now, but it's a slower process. So what you see is that in Europe, you see there was a fall in penetration in 2024. So penetration was moving quite in line with China. Suddenly there was a slowdown, and in 2004, in fact, there was a fall. Now, 2025 was and is a relevant year for the electrification of Europe because there is a regulatory change. So the regulation in Europe basically has a number of steps down in CO2 emissions. And you see that on the chart on the left. And you see that in 2025 was a step down. There will be another step down in 2023, and then it's kind of flat or stable kind of CO2 emission. This is for any company, global company selling cars in Europe. This is the mandate. What is the emission of CO2 that you have to do in your portfolio in the total amount of cars that you sell? And if you don't comply, you have to pay fines. No, and fines that we're talking about. The quantification of fines in Europe is about 15 billion euros, around $16 billion. Is quite a lot. It's quite important. No, so basically, what there is a big step down in 2025, and this was going to create a number of problems for a number of companies. So basically, this was forcing the European companies or any global company selling cars in Europe, when you go to the dealer, to push for electric vehicles. They had to sell electric vehicles, and one way to do that was basically reducing the price of those closing the gap, and this is part of what was happening in Europe. No? Now, the sector was complaining. The sector was saying that this was not fair because there was no demand for electric vehicles. So how can you penalize me and make me pay a fine if I try to sell an electric vehicle, losing money selling that electric vehicle, when the problem is that the consumers, they don't want to buy electric vehicles because there is not enough infrastructure, there is range anxiety, etc., etc. No? So what the regulator did is they did not change the rule. The rule is the same. What they did is to create some flexibilization in the way you do the calculation. So instead of doing the calculation annually, the compliance annually, now the compliance is going to be calculated in 3 years period. So you may not comply with the 94 grams per kilometer in year one in 2025, but if you comply in 2026-27, it's going to be the average of those 3 years, and that helps a lot, no? Because the natural trend is to increase the penetration, and just with that, also you gain some time, and you get some time for the technology to evolve, for the infrastructure to evolve, etc., etc. That made us to change our estimates. So you see that on the chart on the right. The former electric vehicle penetration that we had is the dot line, the blue dot line, and now we have reduced it a little bit. It's not dramatic, but it has an impact in terms of the demand of electric vehicles in Europe, that we were expecting to reach 19%. You have that in the table below by the end of 2025, or average in 2025, and we now expect to reach only 17%. Still, the penetration is going to be increasing. So you see that. So we had 10% in 2021, we had 14% in 2022, we had 16% in 2023. You see that goes down in 2024 to 15%, and we think that it will increase again in 2025. Why? Because in preparation for this, basically what was happening is that all the global OEMs selling cars in Europe, they were bringing electric vehicles. So if you go to a dealer today, what you find is electric vehicles. They're trying to push, they have the product pipeline was focused on electric vehicles, and now maybe they have to push a little bit in terms of prices to sell those cars, but still the cars are there, and still it's about electrification. And so instead of reaching 35% in Europe that we were assuming in 2030, now we are assuming that we are going to reach 30%. So this is where we are. Global volumes are under pressure. We happen to have an out of consensus call that volumes will recover in the second half of the year in Europe, but that's an out of consensus call. Out of that, Chinese companies gaining market share, European companies losing market share, and electric vehicles gaining market share, but slower than we thought before. So with this, Rahul, I think that we have the introduction of what we think that is going to happen in Europe, and maybe I'm going to pass through the ball to John, our partner in Korea, who's going to talk about the view from there and the view on batteries.
Yeah, thank you, Javier. Yeah, so obviously Javier laid out very clearly about what's happening on the EV side, particularly out of Europe. Coming into this year, the overall battery sentiment in Korea was fairly cautious, largely given the fact that two major markets, both Europe and US, had big policy uncertainties. In Europe, which Javier just mentioned, we got a little bit of clarity on that last week. With the European providing, at least the European Union providing a mild degree of relaxation, allowing European OEMs to meet these targets in the span of 3 years rather than 1 year. So clearly that served as a bit of an incremental kind of negative sentiment. Meanwhile, in the U.S., post the U.S. election, there's been a lot of discussions on the status of the Inflation Reduction Act, which has served as a major kind of catalyst for EVs and EV batteries in North America for the past few years. But I think in terms of what's going to happen in the U.S., there's still some uncertainties remaining. That being said, I think post the election, I think the latest market expectation, as well as our official House view, is that among the two components of the Inflation Reduction Act, our team assigns a higher probability of EV tax credits being repealed at some point this year. Obviously, that will dampen EV growth in the U.S. as well. But I think the market was already factoring in fairly conservative EV volume uptake in the U.S. Even prior to the IRA repeal headlines. So we'll see what happens on that. Meanwhile, on the advanced manufacturing production credit, which is a credit given to battery producers when they produce batteries in North America, there's still a lot of debate as to whether that will also get repealed or not. But our kind of at least House assumes that at least assigns a lower probability of advanced manufacturing production credit being repealed, given employment reasons. A lot of Republican states are benefiting from a lot of battery EV JVs and their states, etc. So still a little bit of uncertainties remaining even in the U.S., but I think the market has also factored in higher risk of EV tax credit repeal versus lower probability of AMPC repeal. So, that seems to be the consensus. So, I think all in all, after last week's, clarity on Europe's kind of a policy, at least policy-wise, I do think a lot of negatives are now kind of mostly in the price. Meanwhile, coming into this year, market expectation on EV uptake in both regions were already fairly conservative, given the policy uncertainties that we just talked about. Moreover, battery companies' guidance was also very conservative, as if they were guiding as if the policy will likely get relaxed or loosened. So from where the market was, plus how the companies have guided, I think we were already at a fairly low or gradual EV uptake outlook. And as Javier mentioned, if Europe can still grow to 17% penetration this year, 19% penetration this year, then I think compared to where the market consensus is, we may not see that meaningful incremental downside risk to current consensus numbers, but we'll see how EV sales come out in the next several months. On the capacity cut side, we've seen, just given the slowdown in EV sales in a lot of key markets, we've seen a lot of battery makers reducing, at least announcing to reduce their capacities, and that momentum has accelerated throughout 2024. At least for 2025, a lot of Korean battery companies have, throughout the supply chain, have guided to cut their overall capex by 20 to 40% YOY basis. So clearly, to reflect the slower EV uptake, capacity has also started to adjust. So I think that may be a bit of a silver lining today. And then on top of that, today there was headlines of Northvolt officially filing for bankruptcy. So there are slow signs of a bit of an industry consolidation happening. And then, as Javier mentioned, because of the affordability issue, even on the EV side, so a lot of OEMs are expected to roll out more low-end EVs this year as well as next few years, which implies that OEMs will likely adapt more LFP batteries, which is currently predominantly being produced by the Chinese. Versus Koreans, currently producing mostly NCM batteries. But even Koreans have started to mass produce LFP batteries in anticipation of growth of that low-end segment. And LGS, for example, is expected to supply LFP batteries to Renault from end of this year. And the C-levels recently talked about potentially securing additional LFP orders from different OEMs in coming months or so. So, it's a structural headwind that the Korean battery makers currently face, but at the same time, I think they're trying to at least play a bit of a catch up. And, if they are able to mass produce LFP batteries going forward, then, just given the general dynamics of auto versus auto part suppliers, where auto OEMs generally like to carry, 2-3 suppliers in order to minimize one supplier or one region risk. I do think, Korean battery makers may still be able to secure some LFP orders, perhaps, as a third vendor, if not second vendor. So, we'll see on that. Meanwhile, compared to battery cell, we have another analyst covering batteries materials sector, but just kind of general overview is that market was once again a little bit more conservative than our expectation on the battery cell EV growth for this year. And on top of that, just because even the Korean cell makers are at least expected to produce more LFP batteries. So sentiment on Korean cathode names appear to be even more conservative. So those are kind of the latest highlights or from Korea relating to the EV supply chain. And just one final point to highlight is that for Korea specifically, we've had a fairly extended period of short cell ban. Which was implemented over a year and a half ago. But that regulation is expected to be removed at the end of this month. So hopefully we will have a little bit more foreign investment or flows coming through in Korean market. So that will likely also have a bit of an impact on near-term market dynamics. I'll stop there.
Thanks, Young-Suk. I'll quickly go over to Rachel now. Thanks.
Yeah, thank you. So on China side, demand is actually very good. Demand's being surprised on the upside since 4Q last year because the EV trading program and also because very strong energy storage. Part of that was due to rush export to overseas market ahead of the tariff. But this trend seems to be continuing. So we are seeing March order book. So January, February was weak because Chinese New Year. That's normal. What we are seeing is the March order book for the battery side for the energy storage continue to be very strong. So the order book is up 20%. for the cathode makers, etc. Which is one of the reasons why we are seeing supply response. So one of the major battery producers restarted their lepidolite mine because they look at their order book for the battery side. They feel the demand is so strong that the lithium price will go up. They don't want the lithium price to go up. That's why they restarted their lepidolite mine. So they don't really care. They loss making. They are loss making at the mine. They don't care about the mining side. They want the battery side to be profitable. So their intention is to cap the lithium price, which is what's happening. Is lithium itself becomes very boring. It's going to be range bound. And they only restarted the first phase. They built 2 phases together, 50,000 ton LCE each. So the construction is already done for both. The restarting phase 1, annualized based on the current run rate, it will be around 36,000 annualized for production out of that mine for this year. They already told the market we can easily restart phase 2 if the price going up. So once the word is out there, it's very difficult for the price to go up, even though demand is very good. So that's what we're facing. So I think for investor needs to think of currently in the lithium market is no longer just the miners. The people who are doing the lithium mining are actually your customers, right? The battery company, the largest battery company are doing the mining. And the whole intention for them to go into mining is to make sure the lithium price do not go up so they can make money on the battery side. So that's, I think, the dilemma we're facing right now. Addition to that is one project. So originally we were thinking that this year is going to be more or less getting smaller oversupply, but that restart changed that outlook. And originally our SD model will show 26, 27, we start getting into deficit, a tighter market, more balanced market. That will likely to be changed because Monono project. So Zijin Mining have a Monono project, which it was not in anybody's SD models. The mine will have dispute of mining rights, etc. No one expecting it will getting developed in anytime soon. But Zijin took it over, which is a copper company, took it over, and now the expectation is they will start end of 26, and that's 150,000 ton LCE mine. And so doesn't look like we're going to change the oversupply anytime soon. I think that's it from my side. Hand it back to you, Rahul.
Thank you. And just, I guess, to keep it brief from our perspective, the key things to note are firstly the corporate sentiment. Conversations with corporates have turned somewhat more constructive into 2025. What we've generally seen is that people have seen positive cues coming out of China and other partners across the region, be it Korea or otherwise. So corporates do think that prices have bottomed, and perhaps from a volume perspective as well, 25 shapes up to be a significantly better year than 23 and 24. Obviously, the restart of spare capacity that sits on the sidelines will continue to be a topic of interest and will continue to cap where prices go. But if we look at sort of the sensitive supply on the mining side, for the ones that are higher cost, a lot of that has come out. If we think about Bald Hill, if we think about Nagaju, these plants have been shut down, albeit small volumes. But otherwise, if we look at the mining space in general, people haven't really high-graded in the Australian market. They've continued their CapEx plans, and there's no sort of artificial cost out going out in the market at the moment, which again does raise a few questions as to the length of the price uptick that may come about, because, we're not going to see a significant increase on the cost side anytime soon from our perspective. Look, I'll stop there. As I said, we'll keep it brief from the Aussie side. You can always reach out to me offline. We're going to step into the Q&A section of the call now, and I've got a few questions sitting here. The first one is going out to Young Suk. Young, how do you see POSCO thinking about its investments downstream? Most of the world has seen investments basically be unprofitable. Are they looking to expand?
Yeah, so POSCO Holdings on lithium business, they've been printing, some losses. Obviously, they just began some of their downstream operations from second half this year and more coming in first half this year. So it's highly likely that company will continue to print losses throughout the year. But I think, clearly, I think they're, similar to a lot of EV battery names. A company has announced to reduce their mid to long-term capacity targets. That being said, I think even though company may be losing money in the near term, especially at current price, and even if that prolongs, I think just given the supply dynamics in terms of them the POSCO Holdings wanting to produce their lithium and supply that lithium over to their cathode subsidiary, which is POSCO Future. So it's highly likely that company will continue to at least try to grow the business in the near to midterm. Even if they end up losing a bit of money, because obviously losing money on lithium business is not ideal. But that being said, they also do have a parent steel business which is still generating pretty decent earnings. So there's a bit of a support that can still come from the steel business to allow POSCO's lithium business to kind of at least continue to ramp up.
Got it. Perfect. I might move on to a question for Rachel now. Rachel, where is the cost of production for Chinese brines and hard rock currently?
Brine is very cheap with the new technology from some reason. The cheap 35,000 RMB. So that's 5,000 US. And for hard rock, so lepidolite is a high cost one. Lepidolite varies depends on the grade. The highest cost is the CATL1, which is loss making at today's price. Their cash cost is about 80,000 to 90,000 RMB. We're talking about all costs in LCE form. Total cost is about 110 to 120,000 tons. For lower cost ones, lepidolite will be around from 50,000 RMB to 70,000 RMB, depending on their grade. That's the highest cost hard rock we have. The other hard rock will be even lower price. I think what client wants to know is the marginal cost producer. That's the price I quoted.
That's right. Yep, that's perfect. I believe that's the question as well. Rachel, just a follow up from me. In terms of some of these lepidolite producers, given what the price has done, did you notice in your covered companies for lepidolite or otherwise that you've seen some of the mining grades go up during this period, or have people just maintained their mine plans and either taken a loss or shut down, or have you seen any changes in the mining side at all?
For Chinese mines, aside from that one got shut in September last year and restarted recently, we have not heard anyone really shut down. For Africa, so Zimbabwe mines, we did hear they are cutting production because they want to lower the cost. So they left the lower grade product, the laterite product, in Africa unprocessed because the shipping cost is actually a major component for the African mines. So they only mine and ship the high grade ones, the spodumene, to China to process. That's how they can lower the cost very materially last year, and they are still profitable. So volume was lowered, but still profitable at this price.
Got it. Okay. Javier, next one's for you. There's a general question here, which is asking you on what's the latest in Chilean lithium and SQM.
Yeah. So it's not only, Rahul, it's not only Chile. So Latin America Remember that in Latin America we have what we call the lithium triangle. No, this is the Saudi Arabia for lithium. It's the best place in the world to produce lithium. It's the largest. Each of those countries in the lithium triangle, Bolivia, Chile, Argentina, each of them, we think that they have enough resources to cover the global demand forever. They are low cost, low capex. So it's not only Chile. No, Bolivia continues to be out because of the political model that they have. No, the Bolivian model that is basically the government having control of the operation, so nobody wants to invest in that situation. Argentina, there was a boom when through political cycles. Has been some booms and some slowdowns. Some of your companies have been investing there quite a lot. Now we happen to have a positive political situation. So Javier Milei is a pro-business kind of president and government, and that's helping not only to make the rules of the game more clear, but also helping you to play with a more rational FX situation. So before there was the government was deciding the FX, how you translate the local currency into your currency. Now it's more free market, and that helps a lot. So that's helping a lot Argentina, and Argentina is expanding. But still, you are right, the key country continues to be Chile. No, Chile is where the bulk of the production is today, where you have Albemarle and SQM, the two largest companies. And with the best operation, a lot of experience, etc., etc. Now, in Chile, what we have is that in the last 3-4 years, we had a populistic government. And that's obviously not good in general for business. Said that, this government has tried to change the rules of the game and has tried to open the market to newcomers based on a number of regulations that was supposed to be through a number of steps bringing new players. And those are happening. So there is a number of ongoing negotiations for a number of companies, global companies from all countries. So the idea from the government is not to attract only Chinese companies, but also Australian companies, US companies, European companies to invest, to open new mines. Obviously, those are going to be producing lithium in not this cycle, but the next cycle. Now, what they really did is to get an agreement with SQM to extend the contract that they have that was expiring in 2030, 31. No? So by that, part of that contract was an agreement that SQM was going to increase production. That increase in production was less than we were expecting, was not that much. We continue to feel that after the elections, we have general elections at the end of this year, probably that's going to speed up. So you're going to see announcement of more production, but nothing really happening in the short term. So Chile continues to expand slowly, nothing dramatic, far below the potential based on politics. In general, the region based on politics. The only country that is really growing is Brazil, no? Obviously, from a lower base, is higher cost, is a different kind of operation, but has a more stable political framework that is helping them, Sigma Lithium and other companies, to produce lithium. No? So I think that Latin America, unfortunately, even having the best resources globally, is going to keep losing market share because of politics. We may have ups and downs. Now ups in Argentina, eventually after the election, if we have a pro-business government in Chile also, but is capped by politics, no? Continues to be capped by politics.
Okay, and the next one's also for you, Javier. Do you think that the tariffs in Europe are enough to curb Chinese sales of EVs in Europe?
Yeah, so it's very interesting because when you do the math, and the easy math are done with BYD, the same car that BYD is selling in China, let's say for 100, that car, they have been selling that car in Europe for 200. It's not 20% more expensive. They have been selling that car double the price. So if you create tariffs that is 40% tariffs or 50% tariffs, still for BYD, if they keep selling at the same price, 200, still it's more profitable to sell that car in Europe than in China. So the tariffs are not going to change anything. Number one. Number two, there is open negotiations still to try to reduce those tariffs, and that's important because in the context of global tariffs, etc., both Europe and China have incentives to try to reduce tariffs, so to send a signal that we are not going to be like the US pushing for global tariffs to go up. So there is a case for those tariffs to be reduced, and probably it's going to happen in the next few months. So to send a signal to the US and to Trump that we are reducing tariffs, so why do you keep increasing tariffs? And that will reverse the situation. In the meantime, we think that the Chinese companies are behaving. So for BYD or for any other Chinese company, continues to be very profitable to export those cars from China to Europe, but we think that they are behaving from a commercial point of view. They are not being very aggressive. Still, you see the penetration increasing. So the penetration of Chinese-produced cars in Europe moved from 0%, 1%, 2, 3, 4, 5, 10. Now maybe it's slowing down because of the tariffs, but we are seeing those cars. You see those cars in the streets. You see those cars in the port of Rotterdam. You see, so it's still coming. What we think that is going to happen is that once the negotiations are over, you start to see again an acceleration of that penetration, number one, and particularly once some of those companies are opening factories in Europe. BYD is already working on 3 factories, and then is when you have a big jump because basically they become more aggressive. No, we use Thailand as a reference. BYD was exporting to Thailand also at not aggressive prices, still gaining market share, but prices were not aggressive until they opened the factories locally, and that's when they started to push commercially. And we think that that's exactly what is going to happen in Europe. No, parallel to that, very interesting. What is happening is that European companies that they are seeing that they are going to lose market share, they are rethinking about their strategy. No, and the first mover was obviously Stellantis. They got an agreement with Leapmotor, and basically they agreed that Stellantis was going to be the only distributor of Leapmotor products outside from China. So China is for Leapmotor. Leapmotor cars sold in China are sold by Leapmotor. Everything else outside from China is produced. Today is exported from China, but eventually it's going to be produced and distributed by Stellantis. No, this is really interesting because basically what happens is that in Europe, when you ask consumers about Chinese cars, what do you think about Chinese cars? People say, consumers say, wow, those cars are nice, those cars are really cheap. So are you going to buy one? And people say, I don't know, maybe yes, maybe no. I'm not sure if this company is going to be this new company, this new brand is going to be there next year, and who is going to service my car when I have to fix it in 1-2 years. No, now that changed dramatically if you go to the Renault eventually or to the Peugeot Stellantis dealer, and together with the Renault product and Renault prices, and you touch it, you have the Dacia that is a cheaper option. You touch it, you see the price, and you have in the same dealer. You have this new Chinese brand that you don't know the brand, but it's distributed by Renault or Stellantis, and it's going to be serviced by Renault or Stellantis dealers. No? So what we think that is going to happen is that, you are going to have still an increase in exports from China cars and penetration in Europe. That's going to accelerate once the negotiations are over, the tariff negotiations are over, and particularly once those companies open factories, but also because there are going to be more agreements, kind of Stellantis, Leapmotor, some other Chinese companies are probably going to do an agreement with Renault, probably with Volkswagen, even with the premium companies to produce and distribute those cars in Europe. No? From the European point of view, from Renault point of view, obviously opening the door for Chinese companies to sell more cars in Europe is bad for the sector, but you lose money on one side because you're losing market share, and you were going to lose market share in any case, or you can make money on the other pocket, no? Because you are building those cars, you are doing a better capacity utilization. Remember that everybody is running below capacity utilization. You dilute your cost, research and development, fixed cost. You learn maybe from the Chinese companies in speed to market, software, and you can maybe even make some money on the other pocket, but also controlling a little bit the commercial strategy of those companies. No, so this is what is happening in Europe. You are going to see more penetration of Chinese companies, maybe slowing down a little bit now, but accelerating again. In the meantime, and given that the penetration of Chinese companies is maybe slowing down in Europe and stop in the US, there is not the possibility for Chinese companies to sell in the US. What we are seeing, and this is very clear, a big jump in penetration in the rest of the world, in Brazil, in Mexico, in Latin America, in North Africa, in Asia, and our companies, Stellantis, our companies that those markets are relevant for them, they are suffering. They are suffering because there is more pressure from Chinese companies in other markets. No.
You got it. Perfect. Okay, moving on to Yong now. Yong, there's a question around battery inventory levels currently. What's your read on the supply chain, and where do you think inventory levels are?
Okay. Well, I think a lot of companies don't provide exact kind of inventory data. That being said, just given the fact that we've had an inventory destocking taking place since basically from first half last year, and follow orders throughout second half last year was very, very low. So our checks with recent, through recent company visits suggest that overall kind of inventory levels at the EV battery supply chain, whether it's cathode side, battery cell guys, or even OEM side, things are quite lean. So in the case of unexpected or, better than expected kind of EV sales, there could be room for a kind of incremental orders coming through, but we'll see.
Got it. Okay, perfect. Moving back now, I think, to Rachel. Rachel, do you see potential for domestic production expansion in China, or will it be all through Africa?
There will be some domestic expansion. As I mentioned, the brine is very low cost. So there will be, it's about 16,000 tons, 17,000 tons of the LCE increase this year. Not a lot. Majority of the increase for the global perspective will come in from Africa, Chinese owned or not Chinese owned.
Got it. Perfect. And then there's one here for me which talks about sort of how quickly these projects that the companies have taken offline, how quickly can they restart. Put simplistically, any project in the hard rock space, at least, that was put on care and maintenance and was already producing should be able to restart within, say, 3 months. It's not that big a deal. Other projects which might have shut down as they were being built or as the mine plans were developing into the right parts of the ore body, they can perhaps take a bit longer, but I think the restart time is around that 3-month mark. Okay, so we're nearly at the end of the call. I might take one more question here before we close, and if there's anything else that our viewers want to ask, please come through to us by email. This one is, I believe, for Javier again. How much can European OEMs increase aluminium content to lower the carbon intensity for ICE cars?
Yeah. So the way you reduce, there are many ways to reduce CO2. Obviously, playing with the components is part of that, and that's positive not only in terms of this kind of raw materials, even for tires. No, we have been pitching for Pirelli because the tires were CO2 certified and these kind of things. No, but at the end of the process. And so having aluminium that is certified or tires that are certified to consume less CO2 helps, and that gives those providers with some pricing power. But at the end of the day, it's not about that. It's about electrification. Even not so, because obviously there is a big jump in hybrid cars in Europe, globally and in Europe. It's about electric vehicles. The only way the companies can really comply with CO2 regulation, the big step down is increasing the penetration of pure 100% electric vehicles. No, everything else helps a little bit. The lights, the aluminium, the tires, but it's not that relevant. No, what matters is selling more electric vehicles. To be able to do that, you need to have the products on the dealer, and that has already happened. The only company that was lagging behind was Volkswagen. They have been able to do that in Audi brand, but not in the other brands, and that's why they were lagging behind. But everything else is about having the cars and reducing prices. So the reason or the only way those companies are going to be able to comply is reducing the price of electric vehicles. And that obviously comes at a cost that is dilutive for margins. Electric vehicles are dilutive for margins because they don't have the scale. The cost of producing those cars is higher still today, and the price has to close the gap with internal combustion. That's the only way to out. No, you can help a little bit with small things here and there, including aluminium, but it's not the solution.
Good. Okay, perfect. Look, that's all the time we have for questions today. I'd like to thank all my colleagues here that have joined me, especially Javier very early in the morning for you. Thank you, Rachel and Young-Suk as well. Obviously, a very collaborative team here at Morgan Stanley in terms of the lithium and the downstream market. So keep following us and please keep in touch. Do reach out to us by email if you want to chat further on any of the topics discussed today. But thank you, all the panelists for joining me today, and thank you to all the clients for joining and keeping it interactive. This does conclude today's session. Thank you all, and catch you next time. Thanks.
Thank you, Rahul. You are here to help. Anybody, we're here to help.
Thank you.